Welcome to our latest economic update for August 2024. Today, we're diving into the current state of the major military powers, and more importantly, highlighting key sectors with promising investment opportunities. From manufacturing to services, we'll break down the latest insights and trends that you need to know. So, let's get started. Let's begin with the U.S. manufacturing sector, which unfortunately has been facing tough times recently. In August 2024, the manufacturing PMI, a key indicator of the sector's health, came in at just 47.2%, signaling a contraction for the fifth consecutive month. We're seeing slower demand, weak production levels, and shrinking employment in manufacturing. High interest rates and political uncertainty ahead of the upcoming elections have dampened both consumer confidence and business investment. Despite these challenges, there are some bright spots within the manufacturing sector. Primary metals, petroleum and coal products, food, beverage and tobacco products, and computer and electronic products have shown resilience and even growth. If you're an investor, these areas could present exciting opportunities amidst the broader industry slowdown. Commodity prices are also a factor to keep an eye on. Key materials like aluminum, plastic resins, and steel have seen price increases in recent months. As demand fluctuates and supply chains adjust, these raw materials are becoming increasingly valuable. Industries linked to these commodities could offer strong investment opportunities, especially for those looking to take advantage of price volatility. Now let's shift gears to the services sector, where things are looking a bit more optimistic. In August, the services PMI came in at 51.5%, indicating modest growth. While it's not explosive, the services sector has managed to expand for the second consecutive month, and there are some exciting industries leading the way. Sectors like arts, entertainment and recreation, mining, transportation and warehousing, information and finance and insurance are all experiencing growth. These industries are crucial drivers of the economy, and if you're looking for investment opportunities, these are definitely worth considering. Another strong performer is the healthcare and social assistance sector, which continues to thrive despite ongoing economic pressures. With an aging population and constant demand for medical services, this sector offers stability for investors looking for less volatile options. Finance and educational services are also showing signs of strength. These industries have adapted well to current conditions, and their resilience makes them great long-term investment opportunities. However, it's important to note that not everything is smooth sailing in the services sector. High costs and interest rate pressures are weighing heavily on businesses. Foot traffic at retail venues has slowed, and there are reports of companies freezing hiring and cutting costs wherever possible. While many sectors are expanding, others, like retail, trade, and construction, are contracting, showing just how uneven the recovery can be. So where should you focus your investments? Based on the latest data, there are several key takeaways. First, look at expanding sectors in manufacturing, such as primary metals, petroleum and coal products, food, beverage and tobacco, and computer and electronic products. Despite the broader downturn, these industries are holding steady and growing. Next, in the services sector, consider areas like healthcare, transportation and warehousing, finance, and information. These are core pillars of the U.S. economy and are likely to continue delivering stable returns. Lastly, don't forget about commodities. With rising prices in aluminum, steel, and plastic resins, there are lucrative opportunities in sectors tied to these materials. While the U.S. economy is facing some headwinds, particularly in manufacturing, there are still plenty of opportunities for smart investors. By focusing on resilient sectors and paying attention to commodity trends, you can navigate these challenging times and come out ahead. The second part of the video will focus on China and Russia and what could happen in the coming future. Based on the available PMI data and current economic conditions, the following sectors in China and Russia might be considered relatively resilient. China's technological advancements and government support have made this sector relatively resilient to economic fluctuations. Government investments in infrastructure projects, such as transportation and energy, have provided a stable foundation for related industries. Despite economic challenges, domestic consumption of essential goods and services has remained relatively steady. On the other hand, given Russia's abundant natural resources, the energy sector has been a cornerstone of its economy, providing a degree of resilience. The defense industry, supported by government spending, has also shown resilience in the face of economic and geopolitical pressures. Russia's vast agricultural lands and focus on food production have contributed to the sector's relative stability. When the economy of military powers is in the condition we just described, China, Russia, and the U.S. having varying strengths in their manufacturing and services sectors, combined with ongoing wars in the Middle East and Ukraine, the world would likely face a turbulent and unstable period in the coming months and years. Here's a breakdown of what might happen. 1. Global economic slowdown. China's manufacturing PMI is below 50, signaling contraction, while Russia 52.1 and the US 47.2 are facing slowdowns or slight expansions. This reflects overall sluggish global demand. If these trends continue, global supply chains could be disrupted, especially with China's crucial role in global manufacturing. Ongoing wars in Ukraine and the Middle East could further destabilize supply chains, particularly in energy and raw materials. Key exports like grain from Ukraine or energy from Russia could become erratic, leading to price volatility and shortages in Europe, Asia, and beyond. The instability in Russia and the Middle East, both significant energy producers, would drive up global energy prices, contributing to inflation. Nations highly dependent on energy imports would face economic strain, driving inflation in sectors like transportation, logistics, and manufacturing. 2. Geopolitical tensions and alliances. As tensions between the U.S. and its Western allies with Russia and China continue to escalate, China and Russia would likely strengthen their economic and military ties. Their cooperation in sectors like energy, defense, and technology could form a powerful axis, shifting global trade patterns away from Western-dominated institutions. The U.S. and NATO allies would likely bolster their military presence in Eastern Europe and the Middle East. Increased defense spending and heightened military readiness could strain national budgets, leading to cuts in other areas of domestic spending. With ongoing wars in Ukraine and the Middle East, proxy conflicts between the major military powers, US, NATO, China, Russia, could escalate. This would intensify global instability, create humanitarian crises, and strain diplomatic relations. 3. Economic resilience and sectoral shifts. Despite the manufacturing slowdown, sectors like technology and infrastructure in China would continue to perform relatively well. The government might double down on its domestic consumption and innovation goals, investing more in key industries like AI, 5G, and renewable energy to buffer the global slowdown. However, China's economic slowdown would have ripple effects, especially for countries that depend on its imports or exports, including Asian neighbors and parts of Africa. In Russia, the energy and defense sectors would remain strong due to continued government support and global demand, particularly from countries less aligned with the West, like China and India. However, Russia's long-term outlook could face difficulties due to sanctions, potential technological isolation, and limited access to Western markets and capital. Additionally, the agricultural sector could provide stability, though infrastructure strains from the war could limit output. In the U.S., the services sector shows some resilience, with sectors like healthcare and information holding strong. However, ongoing global conflicts and supply chain issues might slow down recovery efforts. Defense spending would increase due to the need for greater military preparedness, potentially leading to growth in the defense sector and related industries. 4. Impact on emerging markets. Developing nations, particularly those reliant on energy and food imports, would be hit hardest. Rising prices, driven by instability in Russia and the Middle East, could lead to social unrest in countries across Africa, Asia, and South America. Many emerging markets, already struggling with post-COVID debt, would face increased borrowing costs as central banks in the U.S. and other advanced economies raise interest rates to combat inflation. These nations could fall deeper into economic crisis, relying on international institutions like the IMF for assistance, which may come with stringent conditions. 5. Humanitarian crises and refugee flows. The continuation of conflicts would lead to significant displacement of populations. refugee crises would strain neighboring countries, particularly in Europe and the Middle East. Countries like Poland, Romania, Lebanon, and Jordan could see significant economic and social pressure as they host millions of displaced people. Global humanitarian aid efforts could be overwhelmed, especially with major powers focusing on military and defense spending. The lack of resources would exacerbate famine, poverty, and instability in war-torn regions. 6. Technological and energy shifts. The volatility in global oil and gas markets could accelerate the global transition to renewable energy. Countries in Europe, highly dependent on Russian energy, might hasten their efforts to decarbonize and diversify energy sources. This could be a long-term positive shift for the green energy sector, but in the short term it would be costly and disruptive. Technology will increasingly become a battleground for geopolitical power. Both China and the U.S. would ramp up efforts to secure dominance in key areas like AI, quantum computing, and cybersecurity. Meanwhile, sanctions on Russia might limit its technological development, pushing it to rely more on China. 7. Long-term global realignments. Over the next few years, the world could become even more multipolar, with no single dominant superpower. Instead, regional powers like China, Russia, and the U.S. would exert influence over their spheres, and countries in Africa, Latin America, and Southeast Asia would have to navigate between these major powers. With increasing trade barriers, tariffs, and sanctions, global trade as we know it may shrink. Nations might pursue more protectionist policies, focusing on self-sufficiency and regional partnerships rather than relying on global trade networks. This shift could lead to slower global economic growth and new supply chain challenges. In the coming months and years, the global condition would likely become more fractured and unstable. Ongoing military conflicts, economic slowdowns, and shifting alliances will create an environment of uncertainty. For nations, businesses, and investors, adaptability and resilience will be key as they navigate this challenging geopolitical and economic landscape. So, where does all of this leave us? It's clear that the road ahead is challenging, whether it's managing trade tensions, inflation, or the complex geopolitical landscape. But here's the thing. History has shown us that, in times of uncertainty, innovation and resilience often shine the brightest. For investors, there are opportunities on the horizon, whether it's tapping into the growing sectors in technology, energy, or healthcare, or navigating new trade dynamics. And for everyday people, we have the power to adapt and thrive as we work together to build more stable economies and stronger communities. Leaders like Trump and Harris will face difficult choices, but the resilience of the global economy has always relied on one thing: people's ability to push forward, find solutions, and innovate. As we look ahead, we can be optimistic. The challenges may be significant, but so are the opportunities to shape a better future. No matter where the markets go or how global events unfold, the future is full of possibilities. Stay informed, stay prepared, and stay hopeful. Together, we'll navigate this changing world and come out stronger on the other side. Thanks for tuning in, and don't forget to subscribe for more updates and insights. See you next time.